And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
Welcome to The Real Investment Show. I am Danny Ratliff here with Jonathan McCarty for your Financial Fitness Friday edition. Hope everybody's off to a great start this morning. Markets are up. Dow futures slightly higher as we notched our worst day in more than a year. Treasury yields popping just a bit, 4.332 on the 10-year at the moment. We'll see where this thing goes. All ahead of the non-farm payroll jobs report. So I think what we need to be looking for, though, is maybe not the number that we come out with today. Considering the last 2 months, we have seen revisions of 176,000 jobs down. So I think the big news today is going to be do we actually see that they revised February's numbers down? Do we beat the $200,000 or 200,000 job mark for this month of what expectations are? And this is what the Fed's really going to be watching for. Have we created a trend that we are starting to kind of taper off as far as jobs go? Everything else right now, the economy's remained fairly resilient. You know, we've talked about a position where maybe we get into a scenario where the Fed has, the economy has the wind at its back, yet they still go and they cut interest rates, quote unquote, that Goldilocks scenario. But the Fed has a very difficult job ahead of them. I think we're in uncharted waters because we're in this environment where, we've talked about a soft landing, but what if it's no landing as we've seen parts of the economy reaccelerate? I know Lance has talked a lot about, the service industry and manufacturing and how service held things up over the prior years. Now we're beginning to see the complete opposite, yet that manufacturing is not nearly large enough, not to mention what China is doing as far as, decreasing prices with exports as their demand has slowed. And so we're in a very interesting predicament, I think, is what the Fed has. And as I've always said, I do not envy their position. Very difficult scenario here. So we are watching markets, looking at the, been floating around the 20-day moving average historically over the last several months. We continue to kind of bump off of that. So we do like to see how we trade and trend throughout the week's end. I think that's going to be important here because we do have a bit as the markets, and everybody knows it's been a little bit maybe overambitious for a bit here. So we'll see what happens. Nothing materially has really changed, though, in the overall broad narrative. So we do have to be cautious that you're not making a knee-jerk reaction. So, Jonathan, you and I talked to a lot of different people. I know you're probably hearing a lot more concern over the last week. I know I have, just to say, hey, the Dow's down 400 points or 500 points. Well, that is a large number, but percentage-wise, I mean, this is not something that's really uncharacteristic of the markets on a day-to-day basis over a longer time frame, right? We're seeing a little bit more volatility. VIX has picked up a tad bit. Yep. But, what are you telling people?
Yeah, I mean, you have to take it in the frame of perspective. We're still up 10% on the year in the first 3 months of this year in the S&P. So a 1% pullback, I mean, that's just regular market volatility. That's not something to be alarmed about. It's definitely not a reason to reevaluate your overall investment positions.
Yeah, and I think that's a challenge too, because now we've seen, so you mentioned a number for the year of what the market's up, but that's probably not what most people are up either, because, not everybody's invested 100% in the markets, especially at this stage in the game.
Right.
I'm hearing from more people who are saying, I am more comfortable right now taking some chips off the table, getting a little bit more conservative than, I'd rather lose less and gain more is essentially what the narrative is.
Yeah.
But that's difficult too, because now we've seen the treasury yields have popped up a bit. So if you've been in fixed income, that hasn't necessarily been the best place to be. I do think we have to be cautious with that narrative too, just because long term, considering, you've got so many dynamics that we continue to hear about, with it. Oh, we're going to have, a bear steepening. And we talked a little bit about this the other day amongst ourselves that, that's a narrative that is beginning to creep up where we see the long end of the curve go up. And, our stance has been that, long term, we're going to see the long end of the curve come down substantially. And I still think that's likely. The narrative on that is basically just centered around the debt that the government has and people's trust in it. And granted, I know that's a difficult thing right now too, but overall, we're still the best house in a bad neighborhood.
Correct.
And so, when you look at yields across the globe, this is something that if we're going to continue to see, longer term, inflation still coming down, you're going to see growth potentially begin to wane at some point. You're likely going to see a scenario where rates are going to drop. Now, the game may have changed a tad bit because markets anticipated 5 to 6 cuts throughout the year. Looks like it's going to be 2, maybe 3. The market still, in fact, thinks that there's going to be a rate cut in June.
Yeah.
But, if you've been in a bond and you bought it at 4 or, even down as low as 3.8 on a 10-year here earlier in the year, it has not been the best place to be. And so, managing expectations on that, I mean, what are you guys talking about?
Yeah, I have a lot of clients who are heavy into fixed income that are more conservatively postured. And nobody likes to see red in their portfolio. But having the understanding that your thesis is still strong, you're in these positions for the long term, you're not concerned about short-term fluctuations in the value of your portfolio because we're going to be holding these for a specified period of time. Until there's a piece of information that comes out that causes a change in your overall thesis behind an investment plan, there is really no rational reason to start looking at how to reposition.
Yeah, I agree. And so interesting headline just popped up. Fed's cash carry raises prospect of 0 rate cuts. Goldman says very surprising. I think that's probably like the case as well. I personally think you being in an election year, you're going to likely have this administration tapping Powell on the shoulder saying, hey, it's time to cut, bud, because they need right now the economy to continue to accelerate or kind of keep its current track. That's one of the big things, obviously, in an election year. You look at what do these numbers look like and how do people feel? And I do feel like, we've also discussed that, I feel like we're in a tale of two economies where you have the haves and have-nots. People who've had assets have appreciated because of inflation. The people who don't are just trying to make ends meet. And I think that's a difficult thing to marry together when we look at this bigger, broader picture that we currently have. And then not only the aspect of, inflation is not coming down nearly as quick as what they'd expected. So where do you go from there? And I think that's what's really, I think, throwing people for a loop here. Because, okay, you still have this, but yet it's costing everybody more money to do business. It's costing you and I more money than we go to the grocery store. All of you guys out there, I know you feel it in your pocket. It does not feel good. So from a long term, so here's another question I'm getting a lot of, and we're about to switch to break, get into some more topics here in a minute. But what are you thinking from a forecast? I think this is so difficult because we can forecast on a short-term basis, but everybody wants to know big picture, long-term. And there's so many variables that are out there right now that I find it's extremely difficult. A lot of times a forecast can be a fool's errand when you do too much of it. But what are your thoughts on that?
It is difficult to forecast, and because of how involved the world economy has become, there can be a number of factors that are going to influence whether we have the bull thesis or the bear thesis. So, having a balance between the two, as Lance has said, we're at the dance, but we're close to the door, so that we're still participating in the upsides of the market, but we're prepared for that pullback and being able to reposition our exposures accordingly. So I think it's important to be flexible and be open to hearing both sides of the conversation and seeing what type of economic data supports the thesis.
We're at the dance, but we're close to the door. I like that. Hey, when we get back, we're going to talk a little bit about, have you procrastinated? What do you need to do for a tax prep checklist and some really, really late things you can potentially do to help put some more dollars in your pocket? We'll talk about the good and the bad of that. Thanks for joining. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season Candid Coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to The Real Investment Show, Financial Fitness Friday. I'm Danny Ratliff here with Jonathan McCarty and Brent Clanton, keeping us on the air. Has everybody done their taxes? Or April 5th, 10 days away? You filed?
I filed back in February.
Oh,
yeah.
Good for you.
my wife is one of those on-the-ball women, so.
Nice. What about you, Brent? No?
I am Mr. Extension King.
Man, I am too. I am too. Waiting on some documents. But hey, if you have not filed, and we're getting a lot of questions around it, obviously this last week, 10 days away, April 15th, next 2 Mondays from here, you will need to have filed an extension or filed your taxes. So thought we'd spend a little bit of time here on some major questions that we're getting. And, some of this is just some basic stuff, but then also, should we contribute to a traditional IRA or a Roth IRA for 2023, which you still can do up until that April 15th deadline? Or could you use a SEP? And we're finding a lot of people maybe just don't quite understand that either. And so we're going to spend a little bit of time talking about that. Also, if you have any questions, go to YouTube, The Real Investment Show. Go to the chat. We'd love to answer any that we can get to today. So, Jonathan, what are, just basics? What are the basics that most people need to know when compiling this? And, how do you guys go about it in your home, making sure you have everything together and you're not missing anything?
Yeah, well, I'm fortunate enough to be married to a very organized woman. So, when it comes to tax season, she is ready to go. But, it's important that you have all the documents necessary for establishing your tax liability. It's good to have last year's taxes handy so you can refer back to that. A lot of times now, these online tax preparation softwares, if you've used them in the past, they will import all of your information. It's going to save you time. You'll need to have your W-2s or 1099s, depending on if you're self-employed or an employee. Also, anything related to the gains in your accounts. So your 1099 DIV, your 1099 INT, having all of those handy is going to help expedite that process, making sure that you have documentation for any donations that you made throughout the year. We donate to our church, so that's something that's important to have handy as well. And then it will help to streamline everything if you're working, if you are married, filing jointly, if you're working with your spouse while completing your taxes, or if you have one that you delegate the authority to. As the in-house CFA, it is my job to do the taxes for our family. So that's part of the reason why she married me. She does not like doing taxes at all.
You tell her it was CFA, not CPA.
I did make that distinction, but to her, it's all finance. Yeah, so it didn't matter.
So all really important things and just basics. I mean, this is nothing earth-shattering here when it comes to that. But I do think that having a checklist is extremely beneficial. And a lot of times, really good CPAs, if you're working with somebody, will provide you one and say, hey, here's everything you sent in last year. Has anything changed? Did you close an account, open a new account? And that's always a good resource to go back to and just to make sure you have all your ducks in a row. Yep. But if you don't have one, you're doing it yourself, you can do the exact same thing. So like you mentioned, the old tax return is extremely helpful.
Yeah.
Now, we are having a lot of questions and conversations on, hey, my CPA or tax advisor said I could put money into a traditional IRA or Roth IRA and save money. In fact, I had, a CPA client email last week and said, hey, my CPA says if I contribute, if I max out the traditional IRA, that I'll basically the equivalent of saving, almost $2,000 in taxes. And, so start talking about that, right? Because you're essentially getting, the way that the CPA was saying was, well, you're getting free money by putting this in because it's going to eliminate some of the money that you have to pay in taxes. So one distinction, though, I want to be very clear on is that there is a big difference between a traditional IRA and a Roth. I know most of you out there listening probably understand that, but we have gotten a lot of questions about that.
Yeah.
And so let's touch on the primary differences of those and then how you can actually put these funds aside and potentially save money. And we are a big fan of Roths. So, but more and more, I feel like at this week, we're going to hear a whole lot more about the pre-tax, putting those funds aside to help shelter funds from taxes today.
Yeah, and that's the key distinction there. When their CPA told them that it's free money, it's really not free money. I mean, you're just deferring paying the taxes on it now, but you are still subject to taxes when you take those funds out.
Correct.
So it's important to have that conversation with your CPA if that is appropriate for you. There are also some income restrictions as to whether or not you have the ability to deduct those funds. So if you're a married couple making more than $133,000 a year combined, your deduction eligibility is restricted. Right. So then it becomes a conversation of, well, if I can't deduct these contributions to my traditional IRA, maybe I should consider the Roth. We are a big fan of Roth IRAs because that truly is free money when you consider that the growth and appreciation in that Roth account is tax free. Now, you're putting in after-tax funds, so you're not getting any break on the front end, but you're not going to be subject to taxation on the back end. And with where we're heading just demographically in this country, it's very likely we will probably see some increases in tax rates to make up for these giant government deficits that we're starting to run. So I don't know what camp you fall in, Danny, but I definitely, when talking to clients, I'm of the mindset that tax rates are probably going up for people in my generation and later as we get older. The platform of austerity is not very popular for most politicians, so you don't see that coming out very often.
There's no austerity. In fact, it's another $1.2 trillion spending bill. Social Security, I've read something the other day, said that over the next so many years, it's going to be $175 trillion deficit. It's going to be an issue, right?
Correct.
We have a lot of work to do here. So, yeah, I agree. Taxes are going to be higher at some point. So this is where I think it's going to be really crucial to understand where do you think you will fall later down the road from a tax perspective?
Yep.
Now, we do know this tax code expires in 2025, so the very end of the year in 25, we revert back to the old tax code. That may not be a big deal to a lot of people, but your standard deduction decreases substantially. We see the bracket shrink quite a bit and go up a little bit. So that is something that you need to be considerate of when you think of that. Now, I think they could be much more aggressive in the future from a tax perspective that is going to be beneficial to go ahead and, like you mentioned, put those funds in the Roth.
Yeah.
Because all you're doing, you may get some tax savings today, but you will have to pay those later. And we find that not many people retire in that lower tax bracket. By the time you take out Social Security tax, all your payroll taxes, you've taken out your regular tax, you've saved money, you put money into the 401k, you're not maybe going to be all that far off from a spending perspective, what you spend today and what you spend later. And from a tax perspective, that's also sometimes hand in hand.
Yeah.
So when you're thinking about putting these funds aside, I think you made a really valid point, is that you need to think about where are taxes in the future, and deferring essentially, or avoiding is kind of how you look at it.
And then when it comes to the conversation around Roth, there are also some income restrictions there. So if you make more than $228,000 as a married couple, you're ineligible to contribute to a Roth. So then where do you go? Well, for a lot of our clients that fall into that bracket, you have the option of making non-deductible contributions to a traditional IRA. There are no restrictions on contributing to a traditional IRA. The only restriction is whether or not you have the deductibility of those contributions. So the backdoor Roth strategy is something that's often employed by our clients that are in the higher income brackets. You're contributing after-tax funds to a traditional IRA, and then you can convert those funds into the Roth. If you do it quick enough, there is no additional tax due because there's been no gain in the account.
Yeah, and so that is something you do have to be cautious on when we're doing any type of like a backdoor Roth, or especially with the pro rata rule.
Right.
And understanding that if you have additional funds in a traditional IRA, that actual, quote unquote, non-deductible contribution that you're making to the traditional IRA and then doing a backdoor to the Roth could in fact be taxable, or a portion of it, if you have money in that traditional IRA. So there's a lot of little things that I think catch a lot of people by surprise.
Yeah.
Right. There's things out there that aren't necessarily quote unquote. I don't feel like that's low hanging fruit. Like, oh, look, we can do this, but nobody ever talks about that.
Yep.
And that's the part of that pro rata rule, as far as you could have that non-deductible contribution end up being taxable when you make that conversion. So be extremely cautious. Make sure you talk with your advisor. Understand exactly what you are doing. Now, we've talked to a lot of people who are retired and gone back to work, and their CPAs have said, hey, and so these are people who are doing 1099 work, right? So not W-2'd, basically considered self-employed more or less. And they're saying, why don't you do a traditional IRA? What's something else they could do?
Yeah, a SEP IRA is a great option for self-employed individuals. It's very cost-effective. It's easy to do. If you do have 1099 income, you're eligible to contribute to that SEP as long as it is earned income from business activities, and that's also an important distinction. I get sometimes questions around individuals who have rental properties, for instance. If they have them in an LLC, they consider it, it's an LLC, it's a business. But if the sole purpose of that LLC is to hold your rental income assets, those funds do not actually qualify as earned income. That's considered passive income. Now, if you have an LLC set up where you are earning rental income, but as an additional part of that business, you are, say, flipping houses, which has become increasingly popular since the Chip and Joanna craze that has come out. So if that's part of your business, even if you have rental income, you can then use that for contribution into a SEP IRA. However, if you're classifying that as earned income, you're likely going to end up at a higher tax rate. So, it's really important to strategize appropriately as to what the most advantageous path forward is.
Yeah, certainly ways to save some money here, and make sure that you are talking to your CPA or tax advisor on ways that you can contribute and take funds. But, so to give you a little perspective, what's the difference between contributions to a traditional IRA and a SEP IRA?
Contributions to the SEP IRA are also tax deductible as from the business. Now, you can contribute up to 25% of your business income to a SEP IRA. So the contributions are significantly higher on the SEP IRA side versus a traditional IRA side. They're also not subject to income restrictions as to the deductibility of those contributions.
Yeah, and so to give you a little perspective, it ends up technically being for most business owners 20%, and for 2023 is $66,000 that you could put into a SEP IRA, whatever is less or of. And then if you were in a traditional IRA, it's $6,500 and $1,000 more, $7,500 if you're over 50. So quite a bit more, wiggle room there to put funds aside. Now, you do have to consider, is it worthwhile to save those taxes today versus tomorrow? And so, having funds in something else that gives you more tax flexibility may be beneficial, but if your sole intent is to save money today, which most CPAs, think about this, most of them, we grade them on how much money they save us today.
Correct.
Not tomorrow, right? And so make sure you're thinking about the future and that your CPA is being more of an advisor than somebody just filling in the blanks. I think that's extremely important. But hey, we get right back. What if you're taking your RMD? Can you stop or can you actually put those funds into a Roth? We'll talk about that right when we get back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season Candid Coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Danny, inflation's getting bad. You remember back in the day when strippers used to have names like Crystal and Diamond after something really expensive?
No.
The Real Investment Show podcast.
Well, now you go to the men's club, it's like, welcome to the stage, gas and eggs. So, you just know stuff's getting bad, man. Inflation.
Same show, your schedule.
Where'd you get this from, Lance? Is this?
I was thinking about this last night. I was like,
at realinvestmentadvice.com.
Because it's on all cash business.
Yeah.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the Real Investment Show. I'm Danny Ratliff here with Jonathan McCarty. So talked a lot about retirement and things you can do to set aside funds, obviously in light of this tax preparation season that we have amongst us here. Came across an article that says, I'm 74. If I went back to work, could I stop taking my RMD? In fact, I've had a couple questions just like this or fairly similar. So a couple nuances to these. But this is a good question as we're seeing more and more people go back to work. Some just to say, hey, things don't feel real good, would like to continue to work. Some boredom. We've talked about that. Maybe just say, hey, I want to keep my mind going. I enjoyed what I did. Found that, I'd like to go back. Maybe it'd be part-time or full-time. Some, it is necessity for many. And so when, we think about this, what are some requirements if you are over your required minimum distribution age? And that has changed quite a bit. I think you probably get a lot of questions about this as well, where, a lot of people still think it's 70 and a half.
Right.
And, it went from 70 and a half with the first Secure Act to 72. And then with Secure Act 2.0, it went to 73 now, as of this year. And then at some point in about 9 years, it'll be 2033 or 34. It goes to 75.
Right.
So, but what are the prerequisites if you are still working or you've gone back to work? Can you avoid that required minimum distribution that the IRS makes you take from your pre-tax accounts?
So it depends on how those accounts are structured. So, if you have these funds in an IRA, then you are still subject to those RMDs. The exception only exists for your current employer's retirement plan. So that's an important thing to consider. If your funds are still in an IRA, you are subject to those RMDs. And it also depends if your new employer accepts rollovers or not. Not every plan accepts rollovers. The other thing to consider is, have you consolidated IRAs? If you commingle rollover IRA assets with, say, a traditional IRA, which you can combine after you retire, there's no penalty there. But if you've commingled those funds, then you're not eligible to roll those funds back into a company-sponsored plan. So that's one thing that can catch up a lot of individuals if they're not prepared.
Yeah, so meaning that if you're planning on going back to work at some point or think there may be a possibility, make sure when you set up the account, it's a rollover IRA,
correct,
not just a regular traditional IRA.
Correct.
But you made one interesting point I wanted you to elaborate on just a little bit. You said that the plan has to accept a rollover.
Right. Yeah, so not every company 401k plan or whatever type of plan they currently have, not every plan accepts outside rollovers. So if you don't have the option of rolling your funds from your rollover IRA back into that company-sponsored plan, then you are still required to take those RMDs.
Yeah, so meaning that if this is you and you've gone back to work, you have funds in a rollover IRA, you're going to be required to eliminate that required minimum distribution. You will have to put your funds into the company 401k plan, which is why you mentioned they have to accept the rollover, number one, but
right,
they also have to offer a plan. So number two, which you think would be self-explanatory, but
right.
So certainly something to think about. Now, had a question the other day, actually yesterday, and said, can I take my required minimum distribution and put those funds into my Roth? I'd like to grow my Roth more. And so a couple caveats here. Now, in general, if you don't have any earned income, no.
Right.
You also have to be under income limits so if you do have earned income, we have to make sure that you're under those limits so that you can still contribute, or, maybe you can put a phased out amount in, or maybe you can't do any at all. But in general, if you don't have any earned income, you cannot take your required minimum distributions and put them into your Roth. Now, the Roth's a little bit different than your traditional IRA in the sense that you don't have any RMDs. You get that tax-free growth. And I love how the mainstream media has finally, awoken to this great phenomena that you can put these funds here, and maybe, just maybe, this is a great idea. And it really seemed a couple years ago in light of, new tax potential bills that were coming out that said, hey, we may raise taxes, and all of a sudden everybody, jumps up and says, well, Roth IRA is the best thing since sliced bread. It's like, whoa, hang on now. And so a little background on this, Roth IRAs have been around since about 2006. Roth 401ks have really started to become more popular.
Yep.
And this has been a very difficult thing for many people to come around to, because we have been preached and taught to for so long that pre-tax, max the 401k out, get that tax benefit now. And long term, I'm not sure that was the right idea. I think there's some benefit to it, no doubt. But I think that the benefit was to likely the custodian or plan administrator of those, the people holding the assets, more or less, not the plan administrator, but the custodians, which is frustrating when you think about it, because how many people have you visited with who now are like, man, I wish I would have thought about this a long time ago, or I would have done this back then, and actually started to put these funds, because we see so many people that get to retirement and the majority of their assets are strictly in pre-tax accounts, and they don't have much flexibility. So, what do you talk to people about when you talk about, like, how do you diversify? How do you maybe guide somebody to, should you put funds into the Roth 401k, Roth IRAs versus just the pre-tax?
Yeah, and that's where our financial planning comes in. For clients who have done a great job of amassing significant assets, the question then becomes, what are you going to do with these assets when you're passing them on to your beneficiaries? So I think one of the short-sighted approaches to maxing out the pre-tax portion of your 401k, if you end up in a situation where all of your funds are pre-tax and you have an extra $2 million of assets by the end of your lifetime that you're going to be passing on to your children, because of the recent changes to IRA inheritance rules, you're required, if your child inherits an IRA from you, they're required to completely deplete that within 10 years. If you have a $2 million portfolio left over, that's $200,000 a year, not accounting for growth in the account, that individual is going to have to take, that's added to their ordinary income and tax at ordinary income rates. So, it's about appropriate capital allocation just as much as it is, are you going to save taxes today? Yes, probably. But is that what's right for you in the long term? And does that align with your overall goals for your estate?
Well, but not only that, I think there's so many other things that aren't taken into consideration. Social Security taxation, Medicare surcharges, that IRMA we talk about frequently on, what does that mean for most people? And that's another one of those deals that catches many people by surprise. They're like, oh my gosh, nobody's ever told me about this. Why did I not know? And because most people don't even focus on Medicare, just the basics of it until they 64. You start getting the AARP notices in the mail and start thinking, hey, it's time to start thinking about this. Let's go ahead and get this ball rolling. And unfortunately, that doesn't give us enough time to kind of pivot and start thinking about where to put those funds earlier. And so, really good suggestion. I think that you need to start considering that long term, and also think if you are in the same camp that you believe taxes at some point will have to be higher, how do you navigate that, right? And how do you give yourself more flexibility? I've shared this story. If you've listened to the show for a long time, we've had this happen numerous times where somebody's they've done very well for themselves. They've amassed a lot of wealth, but unfortunately, the majority of this, maybe you out there, you put a lot of it into that pre-tax account. You have a pension, and you just don't have a whole lot of flexibility with it. And they say, all right, we've got this bucket list. We want to check off all these goals. And while the goals and everything could be achievable, but what happens is we also need to discuss, we talk a lot, and Lance talks a whole lot about, wealth management. How do you manage money? What are the technical trends, the analysis look like? Should we be risk on, risk off? Should we be reducing exposure, adding to it? But, the other caveat is that how do you keep more money in your pocket? So you visit with individuals who have everything in these pre-tax accounts. They say, all right, we're going to take that big trip, or we're going to buy that second home. And unfortunately, they trigger all these additional taxes.
They do.
And that money all of a sudden doesn't go as far. And so, that's something you do need to be considering as you're kind of moving into or stepping towards retirement. How are you doing that? And so I think that's difficult for a lot of people in the sense of fathoming, because nobody wants to pay taxes. Like when anybody has to write a check to the IRS, it's like, oh man. And so you really have to be, hey, I'm going to hedge my bets. Maybe I put some in the after tax, some in the pre-tax, or, I see a lot of people that go all in. We have a lot of our clients ask, hey, what, my child just started their first job. What is the best thing you could tell them to do? And what would you say right now for somebody who's younger?
Absolutely. For younger individuals, I would absolutely go Roth. You have so much time for the growth and appreciation of that account. And by the time you get later in life, you're going to have a significant asset to draw upon that's not going to have any tax implications, not going to impact things like IRMA, like you talked about. So all of that comes into play, especially at a younger age before their income is potentially over that threshold of being able to contribute to a Roth.
Yeah, no, that's very, very true. And so another thing that I would typically tell people to do is HSA, health savings account, if you're on a high deductible health plan. Unfortunately, a lot of these employers are passing the buck on to the employees. And so meaning that you are on that higher deductible plan, you are going to have to spend more money out of your pocket, which is okay, but you also comes potentially with that HSA. And so not everybody's eligible for one, but if you are, a great tool, gives you triple tax benefit, funds go in tax-free, grow tax-free, and later down the road you can actually pull from them tax-free. So lots of ways to kind of take funds out and have some flexibility with that.
Yeah, another great thing about HSAs, if you're contributing to them earlier in life, and then you get into your, mid 40s, early 50s, which is kind of the sweeter spot to look into like long-term care policies, you can actually use your HSA to pay a portion of your long-term care premiums. So there's an additional benefit there in providing for care later in life.
Yeah. So, and the great thing about that is it's not your FSA, your flexible spending account, where you have to pull those funds out on an annualized basis. You can actually let these things roll. And so you do accumulate assets in them. You can potentially invest them depending on where those HSA funds are. So it gives you quite a bit that you can do with it. I think that should be taken into consideration. If you have the ability to use it, I love this account. We've a lot of times told people, hey, go get your match at your 401k, go back to max out the HSA. And then if you can max out them all, fantastic. But we know not everybody's in that situation. But if you're going to continue to contribute, go back. So, get your match at 401k, max out the HSA, go back to the 401k, and do as much as you can there. And if they've got the Roth, even better in that aspect that you can put funds aside. So when we get back, we're going to talk about, we've got a couple questions on the YouTube chat we're going to get to. Also, Social Security clawbacks. What does that mean? That's something you should be concerned with. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season Candid Coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the Real Investment Show. I am Danny Ratliff here with Jonathan McCarty. So YouTube feed is alive and well. Some good banter going on here. One question. How do you pay for your daughter's wedding if it is $100,000 with a $15,000 gift yearly maximum? Well, you don't want me to really tell you what I think.
Well, someone's marrying up.
Man. So, weddings are always difficult, right? emotional. I always told myself, if you wanted to go make a lot of money, right, you should be in 3 different businesses. It's marriages, funerals, and births, because everybody's emotional about them and everybody wants the best, and I get it. I understand. And if you have a daughter who you want to shower her with love and gifts, completely understandable. Now, number one, $100,000, is that in your budget? Can you afford it? I mean, obviously, sounds like that's probably the case. Number two, $15,000 gift minimum. Now, you're in luck. It has gone up a little bit. It's $18,000 in 2024. It was $17,000 last year. But you could get all the way around that. You're not giving these funds to your daughter. You're actually going to physically pay the vendors.
Right.
And so now, therefore, it is not a gift. Make sure this is in your plan, though. I mean,
I think what he means is, because I saw the comment too, that in addition to paying for the wedding, he's going to give them $15,000 a year. I want that father-in-law.
Is he looking for another son-in-law?
Yeah, no kidding.
Convert to Mormonism.
That's not how I read it, but maybe so. So if you want to elaborate, let me know. Happy to come back to this question. But, I think this is important because we do have these things that come up, and maybe you planned for a $20,000 or $30,000 wedding, and then things start to, kind of, you start pulling the yarn here and things start to unravel, and you're like, whoa, man, this is way more than we anticipated. Yeah. And so we do see that happen often. And so, go back to your financial plan, go back to your budget, make sure that this is something that is achievable. And, one thing we do see is that we often, and sometimes I don't know if it's pride or, what gets in the way, but sometimes we're willing to kind of go outside of our guardrails. And, I think this is really important that you set some guardrails around everything that you do when it comes to money. And this is extremely important to understand that if you're going to go over this, what are the repercussions long term?
Right.
And, being a CFA and a CFP, you can do the numbers pretty quickly, I'm sure here. But, taking those additional funds out can be problematic long term.
Right, especially if you're in the early stages of retirement, or close to approaching retirement. You have a significant drawdown in your portfolio. The long-term ramifications of that are pretty significant.
Yeah. So, okay, not $15,000 more. $100,000 is typical for a wedding. Man, I don't know what part of the country you're in, John, but I don't know. It's been a long time, so I can't say, but I'm pretty sure the average wedding is not near that.
The pink tax has been getting out of hand lately. Maybe he's speaking more recently, and it's especially prevalent in the wedding industry. You tend to pay a little bit more there.
Yeah, Lance says both my daughters have already been told no. You pay for your one-day party. Well, and you do see, I did see some comments here that said a lot of people say, well, what if you gave them an amount to elope or do what you want with? And that's another caveat there. I think if you look up the average wedding, though, it may be a little bit less than that. But, hey, everybody's got a little bit different, card you're playing. So good for you, John, if you can afford it. And awesome for your daughter. So hopefully wish them.
If you're going to spend money on a wedding, here's my advice. Pay it to the photographer and the videographer. The cake you can get at Kroger, but those photographs are forever.
Yeah.
Good point.
How often do you go back and look at those?
You'd be surprised.
Man, we're going on, what are we going on? I don't know.
Careful.
Too long. Kidding, not too long, not long enough. But I can't recall ever looking back. We did a book that the photographer gave us, a little book, and kids like to look at that occasionally. But outside of that, I mean,
actually, with the increasing prevalence of digital picture frames, my wife has one up that just cycles through all of our pictures. So I actually see the pictures from our wedding fairly regularly.
Yeah,
you see them regularly.
Yep, pretty regularly.
It's a good reminder.
Yeah.
My wife planned our wedding. It was $7,000. Lance, yeah, we know why you married her. Now, what you need to do. So one thing we did, everybody's talking about cake on here. So if you're in the car and you're wondering, what are we talking about? Go to YouTube, The Real Investment Show. Go subscribe. Go like. Much appreciated. And let people know. But we actually found a restaurant that's been around forever to do our cake. So it's great because we can actually go back. We got married in Galveston, which is just south of Houston, an island. It's fantastic because we can take the kids and they can actually have part of our wedding cake. So it's kind of cool.
That is very cool.
And, you know, hopefully it'll be there for a while. But, yeah, great tips, guys. It's some funny banter here going on. So one thing that we wanted to address today before we ended the show is Social Security clawbacks. And this actually happens more than I think a lot of people realize. And what this means is that Social Security, for one reason or another, has overpaid you, and they're going to come back for those funds.
Right.
There were over 1 million people last year that had benefits withheld or a reduced benefit because Social Security overpaid them at one point. Social Security, you may not have realized Social Security finally did, and they say, hey, we need our money and we want it now.
Right.
So what does somebody do in this instance?
You know, it can be a very concerning situation. It used to be that if you were overpaid your Social Security benefits, they would actually stop paying your benefits until you paid them back, which for a lot of individuals who are retired becomes difficult because that's one of their main income streams. So it got into a situation where this clearly isn't a feasible system to work. They've made some recent changes now. Essentially, they will take more of a garnishment of your Social Security wages. It's about 10%, I believe, is the figure that's been thrown out. And so they'll take that until you have repaid those benefits. Now, if you can prove that it was not through any fault of your own that this overpayment occurred, then you may be able to get a waiver on paying those back. And also there's some restrictions as to whether or not you have the financial ability to pay it back. So there's a lot of detail into this overall situation. It's important to make sure that you have options and to explore those options, you know, before you get in a situation where you're dipping into accounts you maybe shouldn't to get your Social Security back on track.
Yeah, and so this does happen to people more often than you think. And in fact, I've had this happen a couple times, and did have somebody even with an estate where it wasn't something that they had done, but they get a letter. They were the executor of an estate. A brother had passed away, and Social Security gives them a letter saying they owe like $30,000 something. The estate, yeah. And if the state can't pay it, and the estate had pretty much been dispersed, then they were going to go after the executor. I mean, yeah. Scary stuff, right? Because you're thinking, who can come up? Not everybody can come up with $30,000 in free cash
right.
to go hand over.
And what if it was the Social Security's error in miscalculating all of that stuff?
And it usually is.
Well, that's right. And so now you've got to go through and jump through hoops and go talk to people. And the unfortunate part about dealing with this is that you could call them 4 times and get 4 different answers. And so that's the other very frustrating part about this. But, you know, scary nonetheless when this happens. And so luckily in this instance, you know, it was a little bit of that. Some things had to be repaid. They had done an overpayment. You know, somebody had like disability and Social Security income coming in, and they weren't supposed to be having the exact amount they were. So, but you know, you're talking about months and a lot of time. You know, I don't have much hair to lose, but that would make me lose a lot more. I can tell you that.
Absolutely.
So pain in the rear, but make sure you know that there are options out there. You can apply for a waiver. You can go appeal these things, but you do need to get the ball rolling quickly. When you do receive one of these types of letters, there's typically a time frame that they want to hear back from you in. So be diligent and be proactive with this. Don't wait and let that kind of fester because they will come after you. So markets futures still up a little bit. Dow Jones up 0.27, 106 points. S&P up 20, NASDAQ up 81. Gold's been on a nice little run here up to 23.11. Price of oil, you know, I think a lot of people are concerned with Israel, Iran, what's going on there. And then getting into the summer months, seems like, you know, oil prices are ticking up a tad bit here as well. But, you know, not a whole lot going on until we get this number here in a bit from the non-farm payrolls numbers. Jonathan, from a portfolio perspective, I know you've talked about, you know, not making major moves here. You know, what do you anticipate? Do you have, if you had to throw a number out there, do you think we're higher or lower?
You know, I'm going to take the over on this.
Okay.
I'm going to take the over.
So you're going to take the over? You think that we're going to have more than the 200,000 jobs?
I'm hoping so, yeah.
Okay.
Yep.
Okay.
Let's see some growth here.
You know, that's funny, right? Because everybody wants there to be less. but that means somebody's out of a job.
Right.
Right. And that's what the Fed and the market's been hoping, is that you want that number to be less. Ideally, we always want that to be more, and we don't want that revision to come out. But to create that environment, I think that the market and everybody watching and big money players all want these lower numbers. So the Fed maybe start acting a little bit quicker to hopefully create that environment where we do see another longer run here. So we'll keep our eyes peeled on that. That is going to be the big number of the day. Thank you guys for joining. Please go hit the subscribe, the like button, Real Investment Show, YouTube. We will talk to you guys next week. Have a great weekend.